Good afternoon. Good afternoon. It's Monday, the 22nd of January. Welcome to our latest edition of Market Mondays. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities. If you haven't had a chance to download this week's newsletter, you can do so now by scanning the QR code on screen. We've got a great lineup for the show today. We've got a very strong start to the week. S&P hitting all-time highs, and ASEAN markets are all in the green. With rate cuts looking like it's a matter of time, what will be the impact to the S-REITs, and which will benefit, which ones won't? We have Krishna, our S-REITs analyst, online to discuss this. The semiconductor industry is looking up, but Jarix actually downgraded AEM. So he joins us to explain why. And then finally, Indonesia is growing fast. We actually have a stock that's growing faster, and that's a bank. And we've got Faik joining us to take us through why he thinks this stock is a buy right now. But before we do all that, let's look at some of the market moves. Last week we saw the S&P up about 1.2%. NASDAQ really blazing a trail up about 1.7%. A large part of that is just expectations of rate cuts coming through in the US. Japan continuing to push 34-year highs up about 1.4%, with the BOJ expected to keep easing there, especially given the fact that they're still kind of trying to assess the overall impact of the New Year earthquake there. Some of the more disappointing moves came from China and Hong Kong. Hong Kong HSI down about half a percentage point. Same for the Shanghai Composite as well. Generally quite positive and green in Southeast Asia, with the STI up about 0.4% and the KLCI also up about half a point as well. So let's get in and start looking at some stocks at this stage. Okay, so let's call Krishna online. So Krishna, S-REITs had a pretty strong December, but now they're one of the most underperforming subsectors on the STI. You've actually been talking to quite a few investors recently. So what's the mood out there, and what are some of the concerns?
Good afternoon, everyone. Indeed, Teran, the sector mood swings between one of a cautious optimism and then the very next moment it is of an anxious optimism. So based on our discussion, since we published our outlook piece and a subsequent note looking at how the individual counters are positioned for rate cuts, we will say that quite a few investors are chasing yields, and hence rate cut discussions feature very prominently. Another camp of investors, they are yield focused, but they're probably more tilted towards total return and quality income. The final set of investors, which I will say small in size, are a bit more focused on individual REITs, which are able to preserve the asset values of the properties and take steps to lower the current discount at which the stocks are trading. In terms of the concerns, I mean, the usual stuff, the impact of high funding cost, the asset valuation, and how sector addresses the gearing. The optimists feel that the rate cuts will be the silver bullet, and then the pessimists think that the yield compression cycle is over. So net, interesting time for the sector. And I mean, one of the investors just commented tongue-in-cheek that love it or hate it, but don't ignore the hit, don't ignore the sector. So yeah, I think those are the sort of commentary from the investor discussions.
Right. So don't ignore the sector. I think that's a good place to start, Krishna. So, I mean, you talked about the silver bullet, which is interest rate cuts. And I guess, the markets are pricing in that at some point we're going to see some of these cuts coming through. How will this impact the sector, and who stands to gain the most?
Clearly, the cost of capital will go down marginally. And, as the discount rates go down, you will see the bar for valuation for the sector coming down as well. Further, the competing set of investments like fixed deposits, T-bills, etc., those will hopefully become less compelling. and that may funnel the liquidity towards the Singapore REIT counters. So in our recent report, we have published how the REITs are positioned for rate cuts. I will urge investors to read it and reach out to your sales staff if you have not done it yet. Names like Suntec REIT, CDL Hospitality Trust, and Far East Hospitality Trust will benefit the most based on their reported impact to interest rate changes. In general, we think counters with high gearing, low interest rate coverage ratios should see a change in sentiment, as high interest rate has been a concern for those counters.
Right, got it. We actually have a question from Ian Smith, a client who's online, and he's asking how much interest rate decreases is already priced into the REITs. Any guesses there, Krishna?
Well, I think so. As sort of a back of the envelope calculation, every 50 bips change in the 10-year yield is about 10% change in the fair value. Now, if you look at the sector index itself, it has rallied from whatever 610 to about 720, 730. So I think a good 16 to 18% rally, which I will say that about probably 50 to 75 basis points of change in yield is already priced in. So that's why in our outlook piece, we have mentioned that given the recent rally, I think the sector valuations have become a lot less compelling. And unless there are some deeper rate cuts from here, I think the sector needs to adjust itself. I think the key I guess the positive points for the sector here will be is if we are able to manage the soft landing in US, so we'll have a better global growth and not that much of rate cuts, but still some degree of decline in the rates, or China growth coming back. So either of those two can be, the positive points for the sector itself.
Right. I think, that's one of the key things that we are kind of, emphasizing on overall strategy this year as well, to be a lot more stock specific. So Krishna, let me kind of ask you, the result season is going to start in about a week's time for the REITs. So what are some of the key things that we should be watching out for? And then what are your top picks going into the result season?
So it is still looking in the rear mirror. So result season should be a subdued affair. I think the distributions will be impacted by the continued repricing of the borrowing. At best, they are likely to be flat year on year, possibly some upside for hospitality and the retail REIT from the tapering tailwinds of reopening. Industrial and office are likely to be flat, but clearly there is risk to the downside. Focus will be on the management commentary on the asset values, how individual REITs are positioned for the rate cuts, and if they are, talking up some high-priced hedges or borrowings that can benefit from any rate cuts, and that will be positive for the DPU. So those are the kind of broad commentary that I think investors should be watching from the individual REIT managements.
Got it. So in terms of your top picks, what are they? And I know that some of the top picks have target prices slightly below where the share prices are, but that's more function of you kind of waiting for the result season to come through. So maybe you can take us through that.
Yeah, so the top picks are the top three names are CICT, CAPITALAND, ASCENDAS, and LENDLEASE Global Commercial REIT. CICT, CAPITALAND, ASCENDAS, again, very diversified, liquid, large cap names. You have A-rated credit. So we expect overall the DPU to kind of benefit from that diversification. And then they have the buffers to navigate the repricing of the borrowing. The LENDLEASE Global Commercial REIT, the gearing is high, but you are also getting a 7.5% yield, 20% discount to the book, and overall their asset base are predominantly in Singapore, and also they have relatively big pipeline of assets in Singapore. So it is a bit more of a play on any rate cuts that can happen and the growth that you will get from the future pipeline. But liquidity is low. So if you are in, you have to be in for a long haul. and hopefully you are getting in at a decent valuation. So those are the top three names. The other names which we are also keen on are AIMS APAC REIT, ESR REIT, and Fraser Centerpoint Trust. AIMS APAC REIT and ESR REIT do offer high yield, and they are also positioned to the new economy sectors. Fraser Centerpoint Trust, on the other hand, the yield is relatively on the lower side, but you have an all Singapore exposure with a strong track record and benefiting from the resilient domestic consumption. So those are the kind of names that's featured in our preferred picks.
Great. We'll leave it there. Thanks, Krishna, for joining us. Okay, let's turn to semiconductors. I mean, the industry is turning positive. We did see world chip sales actually recording its first year-on-year growth in sales coming through back in November. And you can see that in our chart of the week. But JARIC has actually downgraded AEM from a buy to a hold. So, JARIC, AEM reported a mismatch in their inventories last week. Can you give us some background as to what happened?
Yeah, sure, Thilan. So basically what happened was they actually reported a mismatch of about 5 to 7% of their inventories, which was lower than calculated from the book end closing of end September. So this 5 to 7% of the inventory level, for the whole inventory level, it's about 358.6 million. So this 5 to 7% worked out to be about 18 to 25 million. So what happened was they claimed to be is that when they were shifting production from Singapore to their new Malaysia factory in Penang, the workers actually key in, or rather the factory manager actually key in the inventory level as well as the size of inventory and the price of inventory into their EMS system wrongly. So this resulted in their inventory level being higher than what it actually is, which also means that their gross margins for their first 9 months were actually lower than what it should be, because they overstated their inventory. So the gross margins were actually better. So they blame it on human error, and they have claimed that it's actually mainly due to the COO who left in October, November last year. But this was not in the announcement when the COO left. They said that he retired to pursue other opportunities. But now when this issue happened, I think the fault in terms of their tone was mainly blame on the COO. Yeah, so they actually mentioned that they set a new team in place, and they found this out in December. So in 2 weeks of December, they actually tried to determine what's the value, and then they announced it as soon as they can, which was 1 week ago. Right. So I think basically that was the whole rather issue of what happened to the inventory for AEM side. Yeah.
Yeah. So, I mean, this is actually a ESG issue in a way. I mean, it is that there was a breakdown in governance. So let's get to that. But how has this all changed your view? I mean, the semiconductor sector is looking up, but you're calling a hold. So, what are your thoughts behind that?
I mean, if you look at AEM, basically they were guiding for second half recovery, and I think even last year some of them, management was saying that it's closer to 4Q. So when the whole semicon was picking up, the other companies were reporting better results, better guidance. We thought that AEM could actually, the management was actually more conservative, and they were trying to like sort of lowball the recovery, for them to outperform. But with this inventory write down, we actually in our model, we actually model for higher margins, but because of this write down, our margins assumption have to be decreased based on, our increase in margins is less than expected, because the first 9 months last year was actually much weaker in terms of margins. So we do expect, in terms of margin recovery for next year to be not as good as what we initially thought of, and also revenue growth for AM likely will be delayed into more of the 4Q. Yeah, so we do really believe that management is not lowballing. I think things are actually quite hard on the ground for them. Intel is doing well, but we do think that because for Intel to order more from them, order more testers from them, the the revenue for Intel should go higher than what it was during the COVID highs before they start ordering new devices. Because if not, there's no need for new testers. So basically, we do think that AEM's recovery should be delayed, and because of the lower margins, we also lower our earnings by close to 30%. 30%. Yeah. So we do think that the recovery will be delayed for AEM, the other players should likely recover first. Yeah, so that's why we actually downgraded AEM. Another reason is also because of ESG. I think that this whole inventory saga thing is quite a novice mistake that a company like AEM shouldn't be making. You know, especially, you know, if other companies we have 10 to 20 customers or more will not make such a mistake. AEM, which derives majority of their earnings from one customer, should even not be making such a mistake, lah, right? So we do think that this actually lowered market confidence, you know, in terms of management execution. Yeah, I think this got quite a big hit lah, in terms of market confidence. So now we are just waiting to see, you know, in terms of the year-end results, what will they be guiding for FY24? And also how do they actually resolve this issue, because they did not actually mention, you know, the team setup, what did they actually do, you know, what is the systems and procedures in place to prevent this from happening again. Yeah, so they said they'll share it more during the upcoming briefing. So we are waiting for that, you know, to see what is up for AEM.
Got it. Thanks, Jarek. I mean, so this is why investors, you really should be paying attention, not just to the financial metrics, but also to the ESG metrics as well. Jarek has rated AEM as a 51 out of 100 in our ESG 2.0 scoring system. So it scores fairly low as it is. Just one thing, our slide says buy on the stock, which is not the case. It's a hold. So we apologize for that. For that. Now let's turn to Indonesia. Thanks, Jarek. And let's call Faik on to the call. Faik has initiated on Bank Syariah Indonesia, and is calling it the king of Sharia banking. Faik, can you give us an introduction to Bank Syariah? What makes it different from the other big banks?
Sure, Talan, thank you. Bank Syariah Indonesia is the consolidation of Syariah subsidiaries of the three big SOE banks in Indonesia, namely BRI Syariah, BNI Syariah, and Bank Mandiri Syariah. This consolidation led to Bank Mandiri, or BMRI, becoming the majority shareholder. One major difference in Bank Syariah Indonesia is obviously the Sharia product that it offers to its consumers, which brings added value, especially for those who believe and follow those exact values, which may have led them to not use conventional banking in the first place. Another would be its focus on consumer financing, especially its payroll loans, which has grown over 20% in September last year, year over year, which we believe will lead to a higher asset yield mix in the future. And we believe its growth prospect is still strong, as Indonesia is also the most most Muslim populous country in the world.
Got it. And so you got a buy on the stock. You know, what's your central thesis?
We have two major factors that we believe will drive Bank Syariah Indonesia in the future. First is, like we said before, it's a potential Sharia industry in Indonesia. Not only is it the most Muslim populous country in the world, but its exposure is actually still at the minimum. Just for reference, Indonesia's Sharia financing market share has only accounted for about 8% of the total national lending and financing, while countries like Malaysia has 33%, Saudi Arabia has 63%, and Qatar has like 27%. And as Bank Syariah Indonesia is the leader in Sharia banking in Indonesia currently, we believe they will receive tailwind as Indonesia focuses more on growing this Sharia industry. Moreover, last year, the Ministry of SOE has announced that they are planning to divest shares of BBRI and BBNI from Bank Syariah, which will likely free up the free float, increase the free float. And we believe this will benefit the stock as it may get included in major indexes like MSCI and FTSE, and its higher liquidity will make the stock much more attractive in the future.
Got it. So higher liquidity potential for index inclusion as well. Those are definitely very positive catalysts. Faik, just my final question in terms of, you know, what are the risks? Is there any downsides here?
Our risk banks on two major things that we see right now is that this year we are cautious about a slowdown in demand for financing and loans in general due to the uncertainty of the election year. And another is that it still has to compete with other conventional banks and as well as digital and other Sharia compliant banks that has appeared in recent years. as they go more and more, we believe there could be short-term margin pressures as they have to maintain their market share and keep their product at a competitive rate in the market.
Got it. I will leave it there. Thanks so much for joining us, Faik, this afternoon.
Thanks.
Now, finally, it's going to be the year of the dragon very soon. We had the Chinatown light up in Singapore just this weekend, and we have published a comprehensive guide to prosperity for the year of the dragon. This is essential reading, I think, if you want to get some ideas on what sectors are going to be prosperous this year, and also for your own personal zodiacs as well, how they how they stack up in terms of fortune. So do download it. It is available as a link on our newsletter as well. Now quickly going to upcoming dates and events. We've got quite a busy week. Result season starting actually this week for the REITs. So we've got Fraser Centrepoint coming out on the 23rd, Suntec REIT on the 24th. And CAPITALAND Ascot Trust coming out on the 29th as well. Quite a few, a lot of macro numbers also will be out this week as well. US final GDP for the fourth quarter is expected, so watch out for those. And then going into events, we've got quite a few events that are happening. On the 22nd, we have a European luxury goods roadshow happening with our partner Stifel in Europe. So if you'd like to join that, please ask your salesperson. We got a Thai Consumer Day. Thailand has been one of the laggards last year, but we think that the prospects for Thailand are improving going into 2024. So do join us for that. And India, it's one of the strongest performing markets last year. We think there's more potential for India this year as well. So do join us for India strategy coming out on the 24th of January. So you can get access to all this simply by speaking to your salesperson. And I'm afraid that's all the time we have today. So thank you once again for joining us this week. Have a great week ahead and have a profitable trading week. Thank you.